Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. I was going to say we are gathered here today to go over some Twitter information. And I'll give you a bunch of my financial opinions as we go. Um, Obviously, you can follow me at finding_finance. You can join the website if you'd like, finding-value.com. Use the word discount and coupon code. We do have a 5 p.m. Mountain Standard Time session, question and answer session, where you can attend live if you'd like. I do record them and post them afterwards if you can't attend, and I answer questions that people have. It doesn't mean I always have the best answers or have the all-knowing answer, especially the short-term market movement type stuff. But I can give you my opinions. I can give you where the value is in the market and all that stuff. So let's dive into Twitter. Let's see what people are talking about. It's going to be financial related, commodities, stock market, wealth building, all those types of things. And I'll just give you my opinions around it. So let's dive in. Let's take a look and see what is going on. So first one says, let me say it again. The Fed broke the housing market. It says 82.4% of homeowners have a mortgage rate below 5%, and 62% have a rate below 4% per Redfin. Notably, 23.5% of homeowners have a mortgage rate below 3%. That is me, baby. Where does the supply come from in the next couple of years? Now, here's the thing, guys. The supply doesn't come from this over here. I don't know why he's correlating mortgage rates and supply. This is demand, and supply never really came from mortgage rates. And even if people were locked into their homes, it doesn't increase the number of homes in the pool. So I don't think that's a very good statement he has there. What I would say is we have very low inventory. People aren't wanting to sell what they have, so they're not going to move up into a different house. Even if they're moving up, you still need the supply of the stock, the home inventory, to go up. Where does that come from? Well, it comes from new home builds. And that is why we're seeing a whole bunch of different home builders at all-time highs. So, I mean, that's where it comes from. It's that simple, in my opinion. And he's making that point that I'm trying to make just to everyone. And this is in the United States. It's not the entire world. It's not New Zealand or Canada. I don't know those markets. I'm only speaking about the United States housing market. If you could give one piece of financial advice to your younger self, what would it be? So what would I share to my younger self? This is what I would tell my younger self. I would say, look, dude, you've got everything right in terms of how much you're saving, your intentions, all of those things are correct. The thing that drives it all that you're missing is the real estate cycle. That cycle is what determines money flows into different assets. And an expansionary phase is commodities if the commodity to stock ratio is cheap. So I would basically say use ratios and look for the real estate cycle. The ratios will tell you what's cheap and what's expensive. Use the real estate cycle for your timing mechanism of when to go long. If we go into an expansionary phase of real estate, that's when you want to go long in inflation-sensitive assets like platinum, oil, and assets like that, and energy. So the real estate cycle is the driver, and what that means is the housing starts is what drives it. It's new home builds and the credit expansion that comes from new home builds. If you were to look at history, you want to look at where the commodity booms were, where they have boomed. And they've all been alongside these real estate cycle booms. So study that as best as you can. And you I don't know how to say this, but I guess I would be thanking myself, somehow thanking myself. You'll thank yourself later, which I'm basically telling my earlier self what I would do. But that's what I would do. And then I would say when we're not in the real estate cycle, you want to be in technology stocks and regular stocks like financial stocks, stuff like that, in the recovery phase of the real estate cycle. So tech stocks and regular like Visa, MasterCard, insurance, all those stocks, you want to be riding those during the recovery phase. And then during the expansionary phase, that's when you want to get long a lot of these commodities if the ratio is right. Housing starts is your buying and selling points. Coming on down, we've got time for another silver squeeze. There will be a surge in SLV call options. This setup is much more compelling than Jan 21 when silver spiked to 27.50. Since then, several hundred million ounces have been depleted, and the deficit has ballooned from 50 million ounces to 400 to 500 million ounces. Silver, so he's a big silver bull, obviously. I'd kind of read his silver tweets every once in a while, and obviously I'd like sharing them with you guys. But we are running deficits, so now it's kind of like a matter of time. It's just taking down inventory, and when the money comes back in the system, that credit expansion phase, what I'm talking about, that is proved to do very well for precious metals. The two biggest sources of broad money creation are 1, bank lending, and 2, fiscal deficits. In order to stop bank lending, you must increase your what? Interest rates. And when you increase interest rates, you increase your fiscal deficits. That is what I was talking about with the Fed is in a hard place because they're screwed no matter what they do. Broad money creation will be created either through bank lending, which if they don't increase interest rates, bank lending will increase. Or 2, fiscal deficits. If they increase interest rates to slow down bank lending, they still create broad money creation. So in the 1970s inflation saga, we had lending dominance, correct. While in the 1910s, 40s, well, even the 40s, we had lending too, and 2020s, inflation sagas, we had fiscal dominance. I would say we have both. During some of these, the 40s was a gigantic lending boom, which occurred with people coming back from war, having kids, and buying homes. And that's also going to happen in the 2020s with the millennials. So I think we're going to see broad money creation go up substantially. Peak demographics and bank lending. Bank lending is going to come, it's going to kick up, in my opinion. This is new bank loans as a percent of GDP, fiscal deficit percent of GDP, and money growth. I do like this chart quite a bit, though. I do. So we're getting it on both accounts. We're getting that increase here in bank lending, which is tied to the new homes. This is basically the housing starts graph. This here is the housing starts graph. This here is your fiscal deficits, and they could both go up at the same time quite dramatically. The 70s, those big waves. So we had a big wave in the 60s, a big wave in the 70s, and a big wave in the late 70s. Those waves were demographic driven. The demographic is what basically created those gigantic waves. And it was the housing market interacting with that demographic. We actually built too many homes here and caused those crashes to some extent. I like the chart, though. It's really cool. Pretty compelling case here as to why home prices won't come down much. It basically comes down to a lack of inventory, too much demand, and a lack of financial available for builders to build more apartments and homes due to tighter lending standards. The perfect storm. And he goes in and talks about his thoughts in this. He's a mortgage broker, from what I understand, and he goes in and talks about it. And that's basically the same type of outlook and paradigm that I am viewing the market with. Very similar. Says, I feel this has always been the case. Bill Miller has said it is easier now to construct portfolios you have confidence will do well over the next 5 years, but more challenging to do the same for a 6-month horizon, i.e., the volatility is the price you pay for returns in this market. So what does he mean? I know we've got a lot of short-term guys. Oh, I need to have it go in a year or 6 months. Bill Miller saying you can construct a portfolio with very good confidence that will do well over the next 5 years, but more challenging to do the same for a 6-month horizon because the volatility is the price you're going to pay for the returns. You're going to have to live with volatility in the short term to construct a portfolio that will do very well over the next 5 years. That is totally true, and that is what I'm setting my portfolio up in. It's for the next 5 years. But in the short term, we're going to see some volatility. It's going to suck. And it's just the way it is. I mean, that's part of the game. But I think if we can get to that third wave, man, it's going to be fun. TTF. So this is TTF, Dutch natural gas. We've got a breakout, a retest, now resumption, question mark. Gas is starting to move again. We've got kind of this channel that was going down. We've broken to the upside. We're doing a little bit of a retest. Are we going to start to move back up again? We could. And I've talked about it. We've got a small inventory of natural gas over there compared to the flow rates and the problems that could be created by weather. We are very fragile to weather in Europe, and that price can move dramatically in either direction. If people front run something, they push the price up, and if that thing never comes, prices are going to fall back down rapidly again. It's going to be very volatile. Brian Gitt, so he says, contrary to headlines, we're not transitioning away from fossil fuels. Harnessing new energy sources did not replace the energy sources we used before. We burn more wood today than in 1800 when it powered 100% of society. The world will use more fossil fuels in 2050 than today. And here's global direct primary energy consumption. Look at the growth in coal, in oil, and gas. I mean, those things are growing dramatically. Solar, renewables, they're very small right now. Now, even if we grow that dramatically, I don't think it will offset anything. This is directly tied to the wealth of human beings on Earth. The wealthier someone is, the more assets someone acquires, the more materialistic items someone acquires, the more homes they acquire, the jet that they acquire, or if they're very wealthy. That it's all basically the ability to consume and use energy. And you're just doing it in different forms. So wealth is directly related to energy consumption, either directly or indirectly. So if you buy an item, that obviously consumed energy to make it and transport it and all that other stuff. It says, please read this thread from Lynn. So many hawks are missing the point that the Fed creates a death debt spiral by hiking rates. Correct. This means we are only delaying inflation with rate hikes, as it causes debt to compound and grow, which will only require greater monetization later. And that's that situation I've been describing, for the past couple of years. It says right now, the bigger source of money creation is fiscal deficits. So raising rates suppresses lending, which is disinflationary and recessionary, and increases deficits, which is inflationary and stimulative. And deficits are bigger than loan creation now. So the deficits are growing as spending and revenue diverge. As you increase interest rates, your revenue is going to decline because you're going to make less money off of the stock market, off of some of these things that we generate tax revenues from, some of the assets. When interest rates go up, we generally get a slowdown. And that slowdown impacts those revenues. Spending has continued to go higher. So it's that delta that's really blowing this stuff to the upside. There's a big delta here. Look at that thing. Coming on down, we got BMA. It says, here too, the scenario seems to repeat itself. I'll wait for you on my blog. This is Banco Macro. Banco Macro. I think that's in Brazil, perhaps. But look at this thing. We are coming on up. We've got a basing pattern here. We've broken that base. We've come back and did a retest where that purple line is. There's your breakout, and here we go. We're starting to move to the upside. It's a very similar pattern to what we had back here for that. So it looks really good. I just like this pattern. It looks really good. Gold. So we've got gold bull flag remains intact. Price target $2,800. I agree. Bull flag, if you look at it from that, you can also say it's a cup and handle pattern that has occurred, and we can move on up. So here is Eric. He says, just how broken is the small mid-cap energy sector at the moment? A Canadian small cap oil company just sold 20% of their portfolio for almost 50% of their market cap. Pro forma, it now trades at 1 times enterprise value cash flow at $70 WTI. When sentiment improves, this is the hunting ground for multi-baggers. I agree. It totally is. And that's where I'm hunting. So Shabam says, legacy shale requires 10,000 barrels per day of fresh production every single day just to make up for its natural decline. 2022 was the last hurrah fueled by higher prices and a complete drawdown of drilled uncompleted wells. 2023 declines will be hard and fast. So get ready here, guys. That's his opinion. We'll see if it happens, but we could get that from the shale area. Coming down, we've got URA update. Broken channel into an inverted head and shoulders. Currently, we are at the red gap zone. So he's got shoulder, head, shoulder on that neckline going across. Could we break up here in the short term for URA and a lot of other uranium equities? Yes, I do think so. And am I playing this short term? I'm not playing it short term, guys. I'm loaded for the long term. All right, across all my portfolio, I'm loaded in the long term. And I just need a few of these sectors to basically hit it. I think they're all going to hit, but if a few of them hit, I'll be sitting pretty. So if you really squint, you can see the housing price crash everyone was calling for. So it's right here. It's right there. There's a housing crash everyone's calling for, and now we're starting to come up. What I think happened is that interest rates went up dramatically. They went up very, very quickly, and I think that shocked the market. And I think people said, I'll just wait until rates come down. And now they're starting to realize that rates, they may not come down very much. So they're starting to get back in the market, and there's not many, there's not much inventory. Their wives are just yelling at them like, dude, you better buy a house immediately. We just had a kid. You got to get in a house. And all that pressure is going on the guy. And, guys they don't want to hear it. They just want to be left alone. They want to kind of chill out. So, of course, they're going to buy a house. They're going to do whatever, just stop the yelling. And that's what's going to go down here. They're going to buy a house, not because they're trying to time the market. I can't imagine how that would go down. Hey, honey, we can't buy a house. We got to wait 10 years to time the market here and try to get the best possible price on a home. She's going to be like, dude, if you want me in your life, you better start thinking about a different plan here. We're going to be getting a house because our kid's not going to be 10 or 12 years old before we buy a house. So yeah, that's what's going to go down there. Coming down, it says degrees that are actually worth the money. Medicine, computer science, engineering, finance, law. What would you add up and subtract? Well, I would say anything here where you're learning something that is driven by math or science. It'd be anything. And that's where I think all of the realities come from. Now, history, that's an opinion on what happened. It's written by people's opinions. A lot of it, even if you know the facts, I don't know what it's really going to get you. This is more like logic-based and trying to figure out problems. Medicine is solving a problem for the most part. It's just human-related. Computer science is basically solving efficiency problems and stuff like that. Engineering's across the board, design and all that stuff. But it's all basically solving problems. Coming down, it says in 1975, it took the average worker 60 hours to buy a TV, 65 for a refrigerator, 18 for a treadmill. In 2013, it only took 7 hours to buy a TV, 20 for a fridge, and 6 for a treadmill. Plus, all these products got better. I will say this. In 1975, you could work less and buy more gold. So you're making more grams or ounces per gold given your time in a year or so than you would in 2013. And gold has been indexed to a lot of things like the real estate market. It's been indexed to oil and all these other commodities. So while this is true using a lot of the technology type stuff, we have gotten wealthier in terms of computers and monitors and TVs. I can't say that's the same for food, for health insurance, for a whole bunch of other things. So I think my opinion is we are far worse off in 2013 than 1975 if you were to price things that are your most expensive items. Like if you were to price your wage in relationship to house prices, if you were to look at how many barrels of oil do you make in a year, what is the cost of your food in relationship to what you make, those types of scenarios, the basic needs. These here, I mean, a fridge is a need, but you don't really buy too much of it. It's a one-time ticket, and I don't buy TVs that often. I've got like two TVs that I've owned for a very long time, so I don't know. This isn't a it's not a huge great thing, but he says houses got better too. That's his opinion, but they now take 2 to 4 times as many hours to buy. Big reason why: supply and demand. No, it's not. That's not the reason why. It's inflation. Inflation. Houses aren't keeping up. Everything else is. We need faster and less expensive methods to build houses. Everything else is built on production lines. Why can't we build houses the way we build planes, cars, and TVs? Well, it's not the building that makes these things necessarily cheaper. I mean, it is part of it, but it's also the economies of scale that some of these things got cheaper, not all. So coming back down, we've got 1 second. Here we go. Man, we covered quite a bit already. Coming on. So I've got some more bad news for the housing crash people. HELOC balances are currently less than 1% of total equity. Leading up to 2008, it hit nearly 7%. It's just not even close to the 2008 market in so many aspects, and it seems many just don't do the research. This is US percent home equity that has been borrowed against in HELOCs. Way down here, guys, this is where it was back in the bubble territory. When we compare the bubble territory to where we are today, just nothing really aligns. Inventory doesn't align. Days of the market doesn't align. These HELOCs, just a whole bunch of different stuff, they don't align because we're not in a bubble. Silver to gold ratio. We're seeing a similar fractal setup now as we did in 08 to 2011. When we broke out, silver started to outperform gold with over 100%. So we could see we went up here, we went sideways at some kind of resistance level, and then we broke out and had a big move to the upside. Maybe something similar like that is coming. That would also indicate that interest rates could fall for a period of time, because that's generally when gold does very well. So maybe we do have a slowdown. Maybe something happens, and the conditions are right for this to occur. It's possible. Can anybody remind me why this is not bullish for silver? Very close to breaking out. So how is this not bullish for a big picture for silver? This is the MACD refusing to turn down. We're just kind of working our way sideways here. We're right against that resistance line, about to break to the upside for silver. It was very similar setup to 2003, where we went sideways, broke out, went sideways, and now we're trying to break out again. So it's the same type of hitting that resistance and then the break. You can even see his arrows pointing very similar to what it was before. And here's your MACD crosses, and we've crossed and ready to potentially head higher. So let's see what happens. I'm a big silver bull. It says, get ready for broader stock market fireworks. The dumb money index is at a high, while smart money has left the building. Smart money confidence hadn't been this low in 2 years. Go Bulls. So this is the smart money. It's way down there. The dumb money's way up here, and this is the S&P 500 rocketing higher. We'll see how this moves. I'm in the camp that I'm not a big S&P 500 or NASDAQ guy right now. I don't like the interest rates. I don't like the inflation and all that stuff. And I know it might have one last hurrah, good for them. But it's overpriced. And I don't go where things are overpriced. I go where they're underpriced. Where they're underpriced is in the commodity sector. So that's where I'm at. And I think if we get an expansion phase of real estate, that alignment there is usually very good for commodities. Question is, when is it going to hit wave 3? Do we have a little bit more of a slowdown ahead of us? No one knows that, guys. And that's why I'm just sticking long, stay long, ride it up. And then when everyone's going to say, oh, you're down a little bit from, the highs. Okay, so what? So what? I'm in it for the next 5 years. Let's ride this thing. I'm going to continue to add into it. So that's my take there. So that's what I've got for today, guys. That's all I've got. If you guys enjoyed it, give me a thumb up, subscribe to the channel, subscribe to the website. We do have a 5 p.m. Mountain Standard Time question and answer session. If you want to join, you can ask whatever you'd like. And I'll see everyone there who's a member. All right, guys, we'll catch you later. This is Finding Value.